Greetings and welcome to the latest installment of Legal Bites, the official podcast of Cummings and Cummings Law, where our primary focus, at least right now, is on helping businesses and their stakeholders redomesticate out of volatile legal and tax environments like Michigan to predictable pro entrepreneurship, pro growth jurisdictions like Florida and Texas. Today, I am reviewing a recent report by Madeline Bursma for Wood Channel 8, that's WOOD Channel 8 in Michigan, entitled 25 West Michigan Businesses We Said Goodbye to in 2025. But before we get into that, a brief introduction. My name is Chad Cummings, and I am an attorney and certified public accountant serving clients in matters of business, tax, and commercial law throughout the states of Florida and Texas. I am Chief Executive Officer of the multi-state, multi-attorney law firm Cummings and Cummings Law. And in addition to my day job, I also teach business and tax law at the university level. I hold 4 degrees, including 2 law degrees, as well as a bachelor's degree in accounting and a master's degree in taxation, in addition to 11 professional licenses and certifications spanning accounting, tax, audit, and of course, the law. My firm website is www.cummings.law. WOOD TV in Grand Rapids, Michigan recently published a list cataloging 25 businesses that closed in West Michigan in a single year. Restaurants, breweries, bakeries, bars, boutiques, music venues, a 75-year-old bowling alley, to name a few. Many of these businesses were not falling apart because of bad ideas or bad management. Rather, in many cases, they were failing because the cost of operating in Michigan has become unsustainable. According to the report, Rockwell Republic in downtown Grand Rapids closed after 17 years. The owner, who operates around 15 other restaurants in the area, said he was not financially responsible keeping it open the last couple of years. In other words, he was paying out of his own pocket to run the business, but kept hoping that things would turn around. Beacon Corner Bar closed after 3 years, citing rising food costs and other challenges. GR Noir Wine Bar and Jazz closed after 4 years, citing post pandemic challenges, changing consumer behavior, and inflation. Wiseman Distillery closed after 6 years, saying it was not able to bounce back after COVID. Onalee's Boutique in Holland closed after 12 years. The owner said that since the pandemic, things have not been the same. You can say that again. And the business saw decreases in sales year over year despite significant effort. Turnstiles, a music venue, closed after 4 years because of rising costs, a changing market, and a real estate deal that fell through. Now, these are not corporate relocations. These are local businesses owned by real people who poured years of their lives into building something, and the business environment in Michigan wore them down. Rising food costs, rising labor costs, lingering damage from the pandemic, inflation, tariffs, regulatory friction, taxes. The margins got thinner and thinner until they disappeared and went negative. And here's the part that should concern every business owner in Michigan. The state legislature is now considering a proposal to raise Michigan's individual income tax rate from 4.25% to 9.25%. That is not a small increase. That is more than doubling the rate. The Tax Foundation, in a recent report, flagged this proposal in its February 2026 analysis of state income tax divergence, as I have covered in an earlier installment of Legal Bites, listing Michigan alongside Rhode Island, Virginia, and Washington State as jurisdictions considering dramatic rate increases that would push them into the top tier of the highest taxed states in the country. That is a hall of fame to which nobody wants to belong. Think about that in the context of these 25 businesses that just closed in West Michigan. These were businesses already failing under a 4.25% income tax rate. What happens to the lingering businesses that are still open if the rate more than doubles? What happens to the restaurants that are operating on a 5% margin when their owners suddenly owe an additional 5% on top of their existing income tax obligations to the state? The math does not work. You do not need to be a CPA like I am to figure that out. And the owners who can see the trajectory will leave before the math gets worse. The Tax Foundation's State Tax Competitiveness Index, which we recently covered, tells the rest of the story. While Michigan is considering raising its rate to 9.25%, 23 other states have reduced their top marginal income tax rates in the last 5 years. Tennessee jumped from position number 38 to position number 8 on the competitiveness index, and that is a good thing. Iowa jumped from 43rd to 17th. Georgia jumped from 28th to 18th. These states are cutting taxes and attracting businesses. Michigan is doing the opposite. The divergence is accelerating, and Michigan is positioning itself on the wrong side of that divergence. If you own a business in Michigan and you are watching your margins compress under rising costs, the proposed tax increase is not a hypothetical or academic threat. It is a very real structural change that, if enacted, will make the cost of remaining behind in Michigan measurably higher than the cost of moving your business to a state with no state income tax. Florida charges no state income tax at the personal level. Texas charges no state income tax at the personal level. Most businesses in these states pay no taxes, and the businesses that do certainly pay less than in Michigan. And the legal mechanism for moving your existing business without starting over is called redomestication. Redomestication is the legal process of transferring the home state of an existing company from one state to another. You keep your existing federal employer identification number. You keep your contracts. You keep your bank accounts. You keep your credit history. And in almost every case, you keep your business name. The company that exists after the redomestication is the same legal entity that existed before. Nothing changes except the state where the company is legally domiciled. It is a non-taxable reorganization event under the Federal Internal Revenue Code when performed by a competent attorney. Redomestication, when coupled with a change of personal residency and a reduction or cessation of business activity in Michigan, can be a very effective mechanism by which to reduce or eliminate tax nexus in the state. For owners of pass-through entities like most limited liability companies and partnerships and subchapter S entities where business income flows through to personal tax returns, the state level savings under a 9.25% rate would be very substantial. A business owner earning $300,000 in Michigan under the proposed rate would pay over $27,000 per year in state income tax for the privilege of remaining behind. In Florida or Texas, that number is zero. Over 5 years, that is $135,000. Over 10 years, that's almost $300,000. And by the way, that does not even factor in likely future rate increases. Now, let me address three alternatives, or at least so-called alternatives to redomestication, and explain why all three are usually inferior. Foreign entity registration, also sometimes referred to as foreign qualification, keeps your company domiciled in your current state. In other words, it does not move. You register in your new state, but you remain subject to taxes, filings, and annual reports in your former jurisdiction. Now you manage two compliance tracks instead of one, and you save nothing, nada, zero, zilch, on the tax side. You just double the administrative burden while remaining fully exposed to those elements that encouraged you to leave in the first place. Old school merger requires forming a new entity. By the way, this is the second so-called alternative in the destination state and merging the old company into it. Now, in very rare cases, we do still sometimes perform mergers as a form of redomestication. But that is not necessary in most states, and it is certainly not necessary in Michigan any longer. Under the traditional merger format, which we generally do not recommend, the old company ceases to exist and you will likely need a new federal employer identification number. And oh, by the way, you may inadvertently trigger a taxable event, thereby requiring you to write a check to Uncle Sam, particularly if you work with somebody who's not experienced in this area of law. You will need to retitle assets, novate contracts, and open new bank accounts. Legal fees for a simple merger, if such a thing exists, can reach $10,000 to $20,000 or more. And if a single consent is missed or an assignment clause breaks, you have converted what should have been a paperwork exercise into an existential threat for your business. Now, finally, option number three is not really an option at all, and it is called dissolution. Dissolution, also sometimes conflated with termination, kills the company. There's nothing left to move. You lose your liability protection. You lose your credit history. If legal or financial claims surface after dissolution, and that happens all the time if you didn't know, those claims can land on you personally, individually, because the corporate veil no longer exists. Unless you are truly shutting the doors and going out of business like those 25 enterprises, dissolution is not a relocation strategy. It is a suicide pact. Well, that's a slight overstatement, but only very slight. The most important document in the redomestication process is the legal plan of conversion. Let me say that again, the legal plan of conversion. That is not a template. That is not a copy and paste exercise. It is a bespoke legal instrument that is prepared with respect to you and your company specifically. Without it, your filing with the Secretary or Department of State or LARA may have no legal effect, or it may result in the unintentional termination of your venture. LegalZoom and Rocket Lawyer cannot prepare a plan of conversion because they are not attorneys and they are not law firms, meaning they do not owe you fiduciary duties like an attorney does. And as of now, the advice from ChatGPT, Gemini, Grok, and Claude is still wrong when it comes to redomestication. My law firm handles redomestications for a flat fee in almost every case. And you can access the exact pricing and complete the process on my website right now, right this minute, without having to wait to speak with me. As an attorney, I personally prepare every document. I don't hire assistants, I don't hire interns or paralegals. I do it myself. And I file with both states in the correct sequence, respond to any inquiries during the process, and to send you weekly written status updates by email until the process is completed. And I back it with a 120% back money back guarantee. Did I say 120% back? That doesn't make sense. Let me say that again. I back it with a 120% money back guarantee if the Secretary of State fails to approve your redomestication and I am not able to fix it, which to date has never happened, as we are truly batting 1,000, not 0.99999, but literally every redomestication I've handled has been approved by the Secretary of State. If you have questions regarding redomesticating your existing LLC or corporation, please use the link in the description for more information on this intricate process and to schedule time for us to speak about your specific scenario. Again, my name is Chad Cummings, and I hope that you found this information helpful. As always, the information in this presentation is general in nature, and it is not legal advice, because legal advice, by definition, must be specific to a particular set of facts and circumstances. Should you have any questions regarding this information or the content of any of my many earlier presentations on these topics, please visit my firm website at www.cummings.law, not .com, but .law, to schedule time for a consultation. I look forward to that opportunity to speak and perhaps even work with you very soon.